Yeah, in terms of corporate credit, nothing really changes because what's good for the markets right now is a divided government. So with the Biden presidency and a Congress and Senate that is controlled by the Republicans, we won't see a huge fiscal spending. The corporate tax rate probably is not going to go higher. And again, we will not really be unwinding all the deregulation that has happened. So from that point of view, I think it's good for risk assets in the medium term at least. So for USIG, one, it's a very safe asset class, comprising of the largest companies in the world with historically low credit loss rates. Two, since 1989, the market has returned very attractive 7% return on an annual basis. Three, in a world where the amount of debt with negative yield continues to rise, USIG continues to provide attractive yield pickup opportunity for foreign investors. And lastly, while there is uncertainty about the path of economic recovery, we believe current valuations provide an attractive risk-adjusted opportunity to enter the market and look for these returns in the long run. And lastly, if I'm not convincing enough, the Fed continues to provide a backstop to the USIG market in the short to medium term through their corporate credit facilities. So stability first. We look for companies which have a stable credit profile. And what we are really not concerned is losing money per se. What we are concerned about is how do we develop that conviction. And this is where our strong analyst team comes into play, helping us develop that conviction with those ideas. Two, we do not take any macro bets in the fund. There is no duration positioning in the fund. We focus on security selection. That's what we know the best, and we spend most of our time on that. Three, we stay true to our style. When we say it's a US investment grade corporate fund, we stay true to that. We are not buying CLOs, we are not buying securitized credit just because they are investment grade rated. We stay true to our style. So simplicity over complexity is what we really believe. So in general, we manage a very liquid portfolio. We are an active manager and we have an opportunistic style. So we invest in securities that are generally on the run. And that's where we are comfortable that we can actually trade them if need be. We don't chase illiquid securities just to add a few extra basis points to the portfolio. This is what really allows us to manage liquidity in our portfolio. Overall, we continue to like the BBB part of the market, especially the lower BBB. There is a lot of concern in the market that lower BBBs may get downgraded. But if you have a security selection approach, we have a high conviction in the names that we own in our portfolio. And for that reason, we continue to like the BBB part of the market. Single A part of the market, we are underweight at this point of time, mainly driven by the idiosyncratic risk that these companies have. Managements may look to lever up, managements may look for acquisitions, which may put their credit risk profile at risk. And from a sector perspective, we continue to like financials and utilities because they are more regulated in nature. And when it comes to technology, media, and telecom, we also continue to like those sectors because they continue to do very well in this current COVID environment. It's important when I look at that question to go back slightly because we've been reducing our risk actually for the last 2+ years because we were not getting compensated for the risk in the USIG market given where spreads were even at the beginning of this year. So when COVID actually hit, we were in a unique position to be sitting on a lot of treasury securities waiting for the right opportunity. And when COVID hit, we were able to actually name our price for the securities. We were actually the liquidity provider in the market at that time. And as an example, we were able to buy some of these high quality single A rated companies at spreads of 200 to 300 basis points, which typically trade sub 50 basis points in a regular market. So we were actually able to take advantage of the sell-off during COVID, given we value liquidity a lot in our portfolio. Just looking at rankings itself is a dangerous game. We've always believed that we are not going to be the top manager every year, and we are okay with that because it's a cycle, and you cannot add to your track record if you're always defending or if you're always chasing, for that matter. We try to keep a calm perspective and continue to focus on what we do best, and that is security selection. What you will see with a lot of managers again this year is they've been chasing because they ended up investing in securities outside of investment grade corporates, and those sectors have not really done well. So you are always going to end up making some decisions which are not ideal when you're chasing, and we don't want to be in that position. We like to keep it simple, and that's what really works for us.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书，投资人须知。